Let's bring in Wells Fargo CFO and CNBC Global CFO Council member John Shrewsberry, who joins us by phone. John, good afternoon to you. Thanks so much for joining us.
Thanks, Will. I'm glad to be here.
Wanted to start on the topic of provisions. Yours, in particular, relative to Q1, up far more than your peers. Why do you think that is? Did you underprovide in Q1, or is your business mix just a lot worse than some of the other banks?
Yeah, I don't think our business mix is worse. In fact, it's probably better given how much less exposed we are to credit card. Really, just the change in the environment and what was knowable at the end of Q1 versus Q2 drove the work that we put into our Q2 provision and allowance build. We've gone portfolio by portfolio and done bottoms-up work throughout the course of the quarter, and I think everybody's got a better line of sight on at least the fact that there won't be a V-shaped recovery. And that in parts of the economy that have opened up over the last few months, we've had some close back down, et cetera. That's all new and incremental news, and different banks will process that differently. They'll apply it to their different types of loans, but that gets us to the level where we are, which at about $20 billion, or call it 2% of our loans overall, actually compares appropriately on a mix-adjusted basis with the others.
What level of confidence do you have, John, that Q2 will be the peak for provisions?
Well, it depends. I mean, we have high confidence if the economic forecast unfolds the way we currently expect it to, which of course is difficult to know. But we've got our own base case, which frankly lines up reasonably well with the median of most public forecasters. We put about a 20% weight on our own downside case, which is substantially more pessimistic than that, just to be cautious in this process. And so we, sitting here today and at the end of the quarter, believe that we've captured all the loss content. You're aware that the accounting for loan loss provisioning for banks changed this year, where we're really trying to capture all of the loss content in the portfolio. And as stating at the end of the second quarter, knowing what we know, we feel like we've got that.
John, it's Sarah. I'm just trying to read your results relative to some of the others, as well as your share price, which has done markedly worse than the other banks this year. And I'm wondering how much of it is a Wells Fargo problem. I mean, it's no secret you guys were struggling for years ahead of the pandemic with the fake accounts scandal and the weight that was having on your business, or how much of it is a problem in the U.S. economy and some of the places that you're particularly exposed to, like consumer and housing.
Yeah, so we all have a different business mix. I mean, so there's definitely some level of the idiosyncratic Wells Fargo story. We have some work to do to repair our relationships with our regulators that we've talked a lot about and is hard underway. But the franchise is very much intact. Our status as the largest mortgage lender, commercial real estate lender, small business lender, middle market lender, all of that is intact. I think bank balance sheets and loan quality, frankly, is as strong as it's ever been going into a downturn in a cycle. Certainly much better, not just for us, but across the board among larger banks versus the prior crisis. So for each of us, it's a little bit different. One of the major areas of differentiation today, you can see in the results, is that we don't have as large of a corporate and investment bank. We don't have as global of a corporate and investment bank. And there was a real opportunity in the first quarter. We had a record quarter for us, but we don't have as much weight on that in our business mix, and that was an outperformer. And then, as we're all providing, Wilf just said some folks put up more in the first quarter and less in the second quarter. We ended up putting up more in the second quarter. That, I think most people believe, will tail off at this point unless things get worse than expected from here. Go ahead.
No, go ahead. Finish your thought, John. Sorry.
Well, and then lastly, I think it's worth pointing out that we have an almost entirely new management team, new CEO, who's brought in a wide array of new leaders. I think they're doing their work. There's certainly investors and other stakeholders watching to find out what that looks like once they've had a chance to put their imprint on the company as a whole, and we're in the middle of that. So some of that came up on our call earlier this morning, but I think by later this year, coming into the end of the first year with Charlie as the CEO, there'll be an opportunity for people to really understand what his intentions are to run the business, over the next several years and how it should compare with peers.
There's also, of course, the Fed asset cap, and it came up on the call as it did last quarter. I mean, Just how much of a hindrance, John, has that been for you and Charlie as you try and run the business in this last couple of months?
It's more recently, it's been more of a constraint. You know, when risk-free rates moved above zero a couple of years or a year and a half ago, and cash flowed out of the banking system, our balance sheet naturally rolled down. People put cash in cash equivalents and out of deposit accounts, and it created some headroom. The reverse has occurred in the last 3 or 4 months as people have been in a risk-off mode and have stockpiled liquidity in the bank. So it makes our balance sheet bigger, even if we're just holding cash at the Fed. And so we've had to do a few things that definitely cost us interest income at the margin to be able to navigate through that, and we'll continue to as long as the cap is in place. So, it's hard to put a number on what it costs, but if our balance sheet were 10% bigger, call it $2.2 trillion versus just under $2 trillion, there's a few $billion worth of revenue, most of which probably falls to the bottom line. So that's the order of magnitude. Having said that, doing the work necessary to satisfy the Fed so that asset cap can go away is the most important work that we're doing, and the ball is in our court right now to get that right and to their satisfaction.
Curious about your thoughts on the bank credit lines. We saw so many corporations draw down aggressively in March and April. Are they paying those back? And what can you tell us about the pace of the drawdowns?
Yeah, so we had about $80 billion worth of drawdowns in March, and some of which bled into the beginning of April. But most of that, I think, was the fear that the bond market would remain closed. And I think those companies, many of whom have a calendar quarter end, wanted to have cash on their books at the end of the quarter. It's substantially all paid down at this point. A lot of it because the high-grade market was a record level of issuance in the second quarter. People went to the bond market, got the cash they needed, paid down their bank lines, and so those commitments are still available, but it's for us and for others. It's just about entirely gone away. And it's a testament to the success that the Fed had in calming markets, because it was a relatively short period of time where that level of uncertainty existed, and high-grade markets in particular are functioning very well now and have been since mid-April.
John, just want to play you a quick soundbite from the call from CEO Charlie Scharf relating to the asset cap and who's to blame for that.
Sure.
The balance sheet cap exists because leadership failed to both oversee and build the appropriate infrastructure of the company, and our financial underperformance is because leadership didn't make the difficult decisions necessary. We also recognize that we've been extremely inefficient for too long, and we will begin to take decisive actions. Since I joined the company 9 months ago, I've announced 6 new members to the operating committee, all coming from outside of Wells Fargo with strong and relevant industry experience.
John, you're one of the few remaining senior managers of the old team. When you hear that, is it quite demoralizing? I guess this isn't Charlie's first earnings call anymore. Are you hopeful that this is the last one of the past blame game and the kitchen sinking?
Yeah, I, of course, would have taken exception with blame game and kitchen sinking, but I know where you're coming from. I think it's a very fair criticism for him to say, listen, I've seen what good looks like elsewhere, and so have some of the folks who've joined us in the last 9 months, and even before, who've joined us from outside. And there's a different way to run this bank, a different way to be structured, a different way to operate, and we're going to move in that direction. And you can't help but contrast that with the way we were structured and operating previously, which was the sum of the experiences of folks who ran the bank previously, who, in a variety of ways, did a great job for a long time. And credit, for example, you would say, has been very well run at Wells Fargo. Capital, liquidity, very, very strong. But operational risk and compliance and just operating in general were not areas of strength. And thank goodness for us that not only do we have Charlie, but this broader team of leaders to be able to make those additional changes to pull the bank into its next phase, which is going to be better.
John Shrewsberry, thanks for joining us on this earnings day. Wells Fargo CFO, the stock down 5%. Worst performer of the financials today and for the year. It's down 55% so far.